Welcome back. My name is Caleb Preston with Alaska Financial Company, and you're watching our video series about how to earn 7% without touching your principal. In this video, we'll discover how investors are lowering risk and increasing returns using alternative investments. In our last video, we learned that the average investor only earned a 2.3% annual return over the past 2 decades. When you factor in that inflation was 2.4%, the average investor's return actually turned out to be negative. Low returns are forcing many investors to lower their standard of living, and some might even run the risk of outliving their investments. It's a serious problem. So, the big question is, how can you avoid it? Well, many advisors are now turning to alternative investments as a way to diversify risk and find above-market returns. For example, David Blanchett, the head of retirement research at Morningstar, says you have to start thinking about moving beyond stocks and bonds. Build a more diversified portfolio that has real estate investment trusts and commodities and foreign bonds. What is an alternative investment? Well, basically, it's anything other than traditional stocks and bonds. Different examples of alternatives might include hedge funds, different forms of real estate investing, private equity, and commodities. Now, these represent the 4 most common groups of alternative investments, but really it's anything other than a traditional stock and bond. Now, while alternatives often generate a higher return than traditional investments, most have their own unique sets of risks. So when you're reviewing an alternative, you want to assess 6 different aspects of the investment to make sure it's right for you. The first is structure. Is it a debt or an equity investment? How is it taxed? What liability do you hold, if any? The next is fees. Are there upfront costs, trailing fees? Who gets paid first, you or the manager? The third is security. What is ultimately protecting your investment? Is the security tangible or just on paper? History. What's the historical fund performance? How is the offering performed? Has it gone through a full economic cycle? Team. Who are the principals? What experience do they have, and how long have they been in the business? And finally, liquidity. Often with alternatives, you're exchanging a high return and diversification for low liquidity. So you want to ask, what's the redemption policy? How easy is it to access my funds? By incorporating these 6 elements into your analysis, you are likely to make a much smarter decision when it comes to choosing alternative investments to add to your portfolio. Alaska Financial Company is an alternative investment that's helping hundreds of investors avoid the retirement crisis. Our latest offering, AFC3, has paid a fixed 7% return since we started the fund back in January of 2009. We don't charge any fees to our investors, and there have been no investor losses in any of our funds since inception. Our executive team has over 34 years experience in this niche, and our most popular investment series, Series C, only has a 1-year lock-in. Here's what some of our investors are saying about Alaska Financial Company. Rick says that he chose to invest since we offer safety with reasonable returns. Harry, a retired investor, says that he's been in the program for years and he's content. And Jeff, who's known my family for over a decade and has been invested with us since April 2011, says it's a unique way to invest and to get a dependable, stable return with people that I know and trust. Are you looking for a dependable, stable return? Do you want to work with people that you know and trust? If so, then you'll want to watch our next video. In it, I'm going to reveal our business model and explain exactly how we're able to pay you a 7% return without you touching your principal. I'll see you on the other side in our third and final video, Start Earning 7% Today. Thank you.